Hey guys, what's up? Welcome to another episode with me, Shashank Guduppa, and I am a SEBI registered research analyst. And today we are going to look at 10 stocks that have recently given management guidance of very fast and aggressive growth. Now, we have started looking at all the con calls, and as you know, we have a very big research team that is doing all of this analysis. So I thought, let me curate this, let me make a very good video for all of you guys. So please stay tuned. And for all of the people who are here for the first time, please click on the subscribe button because we give amazing content on this channel. So let's quickly begin. Now, first things first, we are going to show you which of the 10 stocks are showing the fastest growth plans. Now, please understand, this does not mean that the stock will grow very fast. I am just talking about the fundamental parameters where the stocks have guided very strong growth in the next few years. So we will analyze both the positives and negatives because that is our job. And the 10 sectors that we will be covering in this is a company in defense electronics, nuclear, specialty chemicals, electronics manufacturing, telecom, supply chain finance, managed offices, engineering services, refurbished IT, and regulated generics. Okay, so let's quickly begin. Let's go into company number 1, which is Data Patterns India. Now, obviously, Data Patterns is in the defense space, and we have seen that multiple companies in the defense space have started doing very well in the recent years. And this is in defense and aerospace. Their FY27 revenue growth targets they have given 20 to 25%, and their EBITDA margin they have said in FY25 they will reach 35 to 41%, and they have a very good order book here as well. Now, usually what happens when the guidance comes at 20-25%, and if Data Patterns achieves such a guidance, then obviously it becomes very accretive to the stock price as well, right? Now, if you look at what does Data Patterns do, Data Patterns basically provides radars, electronic warfare, and communication systems. In radar, they focus on advanced light helicopter radar, fire control radar for MiG-29 and Su-30, and we are seeing a lot of defense procurement happening in the ecosystem. In electronic warfare, they're doing radar warning receiver, 5-channel search, and others, right? Communication system, again, they have multiple things here as well. And their biggest customer mix, where is the revenue coming from? 32% of the revenue is coming from BrahMos, which is the missile program that we have, and the DRDO, which is the defense research, which is coming at 29%, and others are 35%. Right now, export is only 4%, which I believe in the next few years, we will see a lot of defense companies doing very well by exporting defense, right? So that has not happened yet. Now, if we went through the entire con call, they have given a guidance of 20 to 25%, EBITDA margin guidance of 35 to 41%, order book is 2,654 crores, and capex which they're going to put in the next 2 years is 150 to 200 crores of capex, and the fresh order inflow that they're expecting in FY27 is another 2,000 crores over and above what they already have, which is 2,654 crores. So this obviously becomes very slightly positive for the company. And if I go and show you the fundamentals of the company, currently it is a 24,000 crore market cap company. Usually in defense we don't look at PE because PEs are very back-ended and lumpy in defense companies, because what happens is when the order comes, the PE can drastically change. When the order is fulfilled, the PE can drastically change. So PE is a very difficult way to look at this company. But if I look at all the other parameters, whether it's price to book, whether it's market cap to sales, whether it's PEG ratio, all of it over here seem on the extended side of things. But if you understand defense and how it works, it has been extended throughout the last 3 years, but it has still gone up, right? So defense actually is a very difficult sector, honestly, to play. This is how the year-on-year returns have gone. And defense is actually a very difficult sector because one big order can change the whole trajectory of the company. So it is more, I would say, a bet on the sector rather than the bet on the company. They are a debt-free company like most of the defense players in the market right now, and they have been doing really well. The promoter has not diluted any stake as of now, right? From the last 3 years, there's no stake dilution in the promoters, but there is stake dilution in the public shareholding, which has gone from 44% to 33%, which shows that there is a good interest from either the DIIs or the FIIs coming into the picture, right? So that is something we're looking at. Now, coming to stock number 2, it is a company called MTAR. Again, it is in the defense space, but they are not just in defense. MTAR started off as a defense company, then they went into aerospace as well, but their main revenue driver was more in the nuclear and clean energy. So the whole AI boom that happened in US, right, where all the AI companies in US started flying, because in US there is something that is taking place right now, a big phenomenon, which is called a bottleneck. AI bottleneck is happening, where they have a lot of demand, but they don't have data centers live. Now, what is happening is in US, a lot of data centers are coming live this year and to next year, and most of the data centers, they need some kind of energy. Again, solar energy was not ready for them. Grid energy is too much. So there was something called solid oxide fuel cells, which came in as a stopgap solution, and a company in US called Bloom Energy was doing this, and MTAR directly supplies these raw materials to Bloom Energy, and Bloom Energy absolutely has been flying in the US. It is just a stopgap solution, right? It is not a very long-term solution. This is only until everything comes back. But if you look at how Bloom Energy went up in the last few years, you can see how the growth of Bloom Energy, and now Bloom Energy has taken a massive beating because the whole AI trend has taken a massive beating as well. And if you look at MTAR's chart and Bloom Energy's chart, as you know, I keep doing my own drawings, but MTAR's chart and Bloom Energy's chart look very similar, as you can see. But recently, MTAR has been locked back into an upper circuit. It has become very subject to change on how the AI in US is working. If that works, this is working in that front, right? So they have actually guided 80% revenue growth, 24% EBITDA margin, 5,000 crores of order book, and 100 gigawatt target by 2047 in the nuclear space. If you look at the business segments, as I said, they're in solid oxide fuel cells, and now many companies in India are coming up with it. There's another company called Carbodium Universal, QME, which is a Murugappa Group company. They, in their recent annual report, they've not even disclosed it outside, but when my team went into the annual report, we realized that there also they've said they're getting into solid oxide fuel cells. So obviously we did our own research, so we know all of this, right? Exports are 82%, as I told you, because most of the money is in exports, and they are exporting to Bloom Energy, as you can see here, and a lot of US companies you can see here, which are mainly in the solid oxide fuel cells. So a single customer, which is Bloom Energy, supplies to more than 70% of MTAR's revenue. So now you know why Bloom Energy's chart and MTAR's chart were very similar, but obviously nothing wrong with that, because if they're making revenue, it is very good for the company, and they have actually grown in that same speed. So management has guided 80%, EBITDA margin they've guided at 24%, plus or minus maybe 1%. Order book at the end of Q1 was 5,000 crores, and they have said that we have received another 800 crores of order today, which is mainly coming in from US, another 200 crores of refurbishment, 130 to 140 crores again expected. So a lot of inbound orders are coming for this company, right? And let's quickly do a check on the fundamentals. They are currently at 156 PE. Again, very difficult to actuate this, but if you look at this company and it is growing at, let's say, 100% growth year on year, even if I do that, this 156 PE might become half at 75 PE. Still on the expensive side, not at all on the cheap side. But these are the guidance that they have given. But again, if you look at this company, it's given 327% return in the last 1 year. And throughout this 1 year, it has been expensive. It has always been, in fact, now it has become cheaper. It was at 500 PE. Now it's gone down to 150 PE. But that is only because of the results also coming with a lot of operational margin, and operational leverage is kicking in, because last quarter they did 11 crores of PAT, and this quarter they did 50 crores of PAT, 5x. So if we look at P ratio and take a call, this becomes very difficult to play. So that's why I told you, in the world of defense, if you are a normal investor looking at P ratio and all, it will be very difficult to play this game, right? Because you would have never expected or done any calculation where you would see 11 crore PAT becoming 50 crore PAT, like 5x, right? And that your EPS has gone from 3 to 16, and that's why the 400 crore P has come to 160. But a lot of people have done this math, and that is why they are playing on this journey, right? So that was company number 2, and this is what the management has said, which seems like a very interesting point. But please note, most of the revenue, which is on the risk side, comes from majorly Bloom Energy's revenue, right? So you have to be very careful on that front. Okay, now coming to the third company, but before we go into the third company, I just want to share a very good update with all of you guys. If you remember, last year we started our small cases on October 2nd. Now the last year has been horrible, but in the last 1 year, all our flagship baskets have done amazing, and it has been very it's like a proud feeling for me, because we have beat all indexes across the period, across the baskets, right? Obviously it has been a terrible year for the markets, but whether it's our quant momentum portfolio, whether it's our compounding basket, we have beaten pretty much all index, including the small cap index as well, because small cap index is the one that has actually rallied this year, and we have outperformed every single index on this chart, and it is still doing well. So again, I just wanted to be very happy about it. And if you're looking at these small cases, I will send you the link in the comment section below, right? And there's also a discount of 20%. Now coming to company number 3, which is in the chemical space, which is called Tatva Chintan Pharma Chemicals, right? Now again, this is a company that is basically working on electrolyte salts for batteries, pharmaceutical, agrochem intermediates, and it sells around 214 products across 4 different categories. And basically what they have said is, they have said 25 to 30% FY27 revenue growth guidance, 40% revenue share, 70 crores to 80 crores will come from new pharma molecules, and they have 214 products. So structure directing agents, 41% revenue, pharmaceuticals and agrochem, which is PASAC, PASC, 34%, PTC, which is phase transfer catalyst, is around 23%, and electrolytes and salts is 2%, right? Now coming to what they have actually said. So one of the key drivers of HDA is basically something called Euro 7 implementation, and that is basically coming and kicking into the entire revenue that is slowly coming in, and that is why the guidance has actually gone up quite a bit for Tatva Chintan. In fact, we are going to do a webinar very soon on the whole chemical sector, and maybe I can show you some information there. 3 new molecules are contributing 70 to 80 crores revenue for pharma and agro. Stationary storage, ESS, again they're doing a hybrid battery for a customer, and that is expected in October to November, right? And main thing is in semiconductors, they are also there now. they are doing a first plant scale batch qualified, large scale commercialization coming in 2028. But please don't get too excited with semiconductor name in the industry, because everyone's factory is coming up in 27 and 28, right? So there will be a lot of supply flooded into the market. So don't get very excited. Now, obviously, a lot of you guys would ask me, what is Euro 7 and why is it a driver? So let us understand that, because I'm assuming you're here to learn, right? So basically, Europe has a commission, a standard, right? So Euro 7 is basically European Union's next generation vehicle emission standard. And Europe takes their vehicle emissions very seriously. And they are planning to design and reduce the pollution from cars, vans, trucks, and buses. Obviously, they have started going more into electric, but their main goal is to ensure that we don't pollute the ecosystem, right? So why Euro 7, something that happened in Europe, benefits Tatva Chintan in India? Because Euro 7 forces vehicles and heavy duty trucks in particular to meet stricter emission limits. Catalyst manufacturers hitting those limits need more advanced zeolites, and those zeolites need higher quantities, more sophisticated SGS during manufacturing, and that is something Tatva Chintan is ready to supply. So the company spent several years developing Euro 7 compatible SGS and says complete Euro 7 portfolio is ready, and this becomes a key growth driver for this entire company. It is the largest and only commercial manufacturer of SGS in India and the second largest globally. So the entire Europe becomes a massive demand driver for this company, and also it is very unique, and this might play out over 3, 4, 5, 6 quarters. I don't think it will be a 1 quarter story. This can become a multi-quarter story if this actually plays out, right? So that is something that we are again very bullish on. Now, if you look at Tatva Chintan more on the screener perspective, let's look at the fundamentals. It is sitting at 78p, so slightly on the higher side. Market cap to sales 7.35, and market cap is actually at 4,000 crores. So it's not a very big company, but I would say a lot of research analysts have started witnessing this stock because they know how big a driver Euro 7 zeolites would be. And if you look at this, the chart, it has actually just gone up. It has not gone up before. It has just started going up. It has not even started the journey. I think above 1,800 this journey would start. And some big player has also come in and invested in this company just now on July 21st. So something big is happening. And if I go and check the quarterly results, you can see that the growth has started kicking in the quarterly results compared to the last 4 quarters. So now the turning point has come in, and we can slowly see the 7 crores has become 16 crores. So again, the PAT has doubled. So operating leverage is also playing out. Margin is going to play out. And this is very interesting because even if you look at the global scenario right now, recently Tata went and bought a heavy duty electric truck company in Europe. I think it was Iveco. So a lot of things are changing in Europe, and that is something that is driving this entire force, right? Now coming to another company called Syrma SGS Technologies. Again, very interesting. It's a Chennai based electronic manufacturing company. In fact, by the time I was doing this video, it was close to an all-time high breakout as well. And they basically focus on RFID solutions and medtech ODM services, right? They are guiding 35% revenue growth, 6,000 crores of order book, 5,000 crores of order book will execute now in the next 12 months. And they have 25%, which is original design manufacturer mix, right? If you look at the revenue contribution by industry, 32% is Indian consumers, industrial is 28, automotive is 24, healthcare and IT are 16. Domestic is 75, exports are 25, and their clientele is almost most of the bigger players right now in India right now, right? So this is something that looks very interesting, and they want the ODM mix to go from 17 to 25% of revenue, and that basically starts giving them a lot of advantages playing forward, right? Now, what they're saying, why ODM is important and why exports are important, because both ODM and exports, right, become a superior margin profile. And these companies like Dixon, Syrma, Keynes, all of them operate at very bad margins, very low margins, because they play volume game. But if I can play a volume game and I can increase my margins, then I become a very profitable player to play with. Because these companies have to put a lot of capex, a lot of plants, and interest cost will come, debt will come. So all of those things come. ODM doubled year on year, and management wants it at a quarter of the revenue. So they want to now push it to 25% of the revenue. That is what the management basically said in their con calls, right? And if we look at the fundamentals of this company, you will see that the fundamentals are here. 24,000 crore market cap. So it is almost in the mid cap to large cap space. 74 is the P ratio. Market cap to sales is 5. 1 year return is 99%, and PEG is 1.88, right? As you can see, it is growing. And as I told you, when I'm shooting this video, maybe it'll come out later, but it is close to an all-time high breakout, and it has been growing very aggressively over a period of time, right? If I look at the sales, you can see the sales here. The sales have in the last 3-4 quarters have started becoming very aggressive, and the PAT again quarter on quarter has doubled. So that means the PAT again is doubling. And if this continues, again, we don't know if it will continue, but from what they're saying, if ODM becomes a key growth driver, then the PAT will again start normalizing, and the P ratio will start normalizing, and the growth curve will start kicking into this company as well. If you look at the shareholding, it is at 42% on a yearly basis, and the public shareholding has gone from 39 to 34. Some DIs and FIs have started entering the space. So this is something that we need to keep our eye out when we look at stuff like this. Next, comes HFCL, Himachal Futuristic Communications, which is in the telecom space. And this was actually doing really well because of the optical fiber cables that they have. Now, two companies in this space, which was HFCL and Sterlite, were doing very well because again in US there was a massive demand for optical fiber cables and optical connectivity. And there was a company called Sterlite Technologies in India that did well. HFCL did well. And in US there was a company called Corning Technologies, or GLW. If you search for it, you will understand it. They are the pioneers in the space, right? So what is HFCL doing? HFCL has said that they're going to project a 40% growth year on year. 59% will come from the telecom industry. 41% they're going to exports, and defense 33,000 crores they will make from that. So if you look at telecom, right now telecom is their main revenue driver at 60%, and 38% is from turnkey contracts. And HFCL provides to everybody: Jio, Airtel, BSNL, all the bigger players. And right now, if you look at the beauty of this, last year their export mix was 12%. This year it has become 41%. So that has become a very big driver of the revenue. And obviously this was mainly because of the growth that was coming in the US market, right? So export-led optical connectivity, fast-scaling DCI was ramping up, and that is why you saw the massive growth coming for Sterlite and HFCL. Please note that the AI bottleneck in US is not over. Another 2 years tak chalega, 1.5 to 2 years tak chalega. And I believe that more and more optical-led connectivity will be required from all the global players. There is a demand and there is less supply, so these companies will continue to get more export orders. But after that, you will see a massive dip in their revenue, so be careful. So you have to time your growth story. If you say, Shashank, I'm going to be a long-term investor for 10 years in this company, you are in for a big surprise after 1.5 years, right? The minute the AI data center supply-demand situation is over, this company's growth, which is coming from that, will definitely fall, and the market will punish it as well. So I'm assuming you're watching this video to learn, so I hope you're learning a lot, right? And if you look at the management, what they said is they are saying that they want to double down on their growth from 20% to 40%, mainly led by the optical connectivity boom in US. And they're saying that this is a new growth regime, and that is why it is growing aggressively. Please note, this is a temporary growth regime, not a permanent growth regime, and this will also get commoditized very soon, right? So that is something that we are looking at. And they're also giving some aggressive target. It's saying 3,000 crores will come from defense and aerospace, and then 5,000 later on. So they are going very aggressive on that. If we look at the company, what they've said, if you look at the fundamentals of the company, I will show you that also. The company is HFCL, 31,000 crore market cap. 1 year return is 191%. 55 is the P because it has been growing aggressively, mainly driven by export orders. PEG ratio is 46, way beyond what is what is normal. And you can see the growth has just been a very fast growth, right? From 70 rupees to almost 224 rupees. That is a growth that they've given. Again, very difficult to judge these companies with P ratio, because if you had judged it with P ratio, I don't think in your wildest dreams you would have thought it will go from minus 29 to plus 246. So these type of companies, the fastest growing companies, you have to play more on the sector knowledge, whether the execution is happening quarter on quarter, and more on the management conviction, right? You can't play on just today's P ratio, it will not work. So you have to assume, because nobody could have predicted this kind of growth, right? And when you know what's happening in the US, you can take some bets in India and actually make good money on that. So that is the only way you can actually play this. So this company is very interesting, and also this company is growing as fast as possible. But again, as I told you, it is a very sustained growth, so be very careful about it. The growth can also fall down quite aggressively. Okay, awesome. I hope you guys are not bored with this entire video, because as you can see, we have put a lot of effort into this. But again, a good feedback would be appreciated. If you still like the video till now, please click on the subscribe button and we'll go to the next company. The next company is a company called SG Finserve, and I had covered this long ago. There were two companies I had covered long ago. I don't know if you guys are here from before, but you remember we covered a company called SG Mart and SG Finserve. Now, I was very bullish on SG Mart 2 years ago, and I think now it has started moving. But why was I so bullish? SG Mart is basically a company from the Apollo group. Okay, Apollo is a big group, APL Apollo. And what they were doing is they were doing buying and selling, trading of commodities, right? Of steel products and all of that. So they used to go to the big players, buy in bulk, and then they used to eliminate all the middlemen and go directly and sell to the customers. And SG Mart was that company, and the company that was financing all of these equipments was a company called SG Finserve, which is a subsidiary. So anyone who wants to buy, let's say, tubes or wires or any kind of metal products, they can come and say, SG Finserve, please give me some credit, 30 days, 60 days, give me some loan, and SG Finserve will do it. SG Finserve had zero NPA loan. Okay, zero NPA. That was their gross NPA even today was zero, because they're lending to their own vendors. Apollo ka hi vendors ko they're lending at some interest cost, and they have zero NPAs. It is crazy. So they have now said that they will grow their AUM of lending to 25-30%. Profitability will grow by 30 to 35%, and the AUM with no fresh equity means they don't have to dilute any more equity to get to this number, which is 10,000 crores. And if you look at this, their core offering is supply chain financing, channel financing, financing and working capital financing, and they have said that they will start growing very, very aggressively. They have also got into insurance, so then now they're going into insurance broking as well, and they're going to start digital lending and loan against property also. So they started off as a vendor servicing, vendor financing platform, but now they are slowly evolving into something much bigger. So management has said they will grow at 25-30%, and insurance broking subsidiary is coming as well, which they will again do B2B cross sell inside the existing ecosystem, and insurance commissions are very high, right? And that is something that they're coming up. And they're also saying that digital lending and loan against property is sitting in the plan, and again they will do it to their internal customers first, and they're saying that per employee profitability of 2 crores per annum is what they're basically targeting. If I look at the fundamentals of this company, you will see, first I'll show you SG Mart. Like, this is the bigger company that is doing this, where they buy and sell these things, okay? And they're a part of the APL Apollo group, which is a very big group, right? And if you see the company, I was covering it 2 years ago, and 2 years ago it was somewhere in this zone, completely flat, and now after that from 348 it jumped to 700, basically doubled in a span of time. I was not wrong on the thesis, but the stock price took its own time to move, because if you look at the growth of the company, it was absolutely bang on point and correct, and they are very profitable, right? It's beautiful the way they operate. Now coming to the subsidiary company, which is SG Finserve, again from the same group. It is usually at half the market cap. Here it's a lending company, so we look at price to book, not price to equity. And if you go down, you see same trajectory here. It didn't move at all, and then straight away from 350 to 700. This also doubled in literally a year, in such a bad year. And this will keep growing because look at this. The credit book is growing. It's like any NBFC. Now, most of the time what happens, most NBFCs have this kind of growth, right? But the problem with most NBFCs is that GNPA and NNPA, which is bad loans. This company has zero, because they're lending it to their own vendors. The minute they go out is when you'll have problems. But if I'm lending to my whole ecosystem, they currently have zero NPAs, which is mind-blowing. So they're making full profit on everything that you see, right? So that is a beauty of this company, and I believe that this should, continue to do well. And if you see, the promoter also has increased his stake from 48% to 56%. Promoter is buying. So this is very interesting, and this is a very long-term strategy kind of a company. And when I had done research on it, I had done research on companies in Japan, where trading companies are one of the largest companies in Japan, right? If you look at Warren Buffett, he had bought trading companies like Mitsubishi and all of that. And this company does exactly what those companies are doing, right? So very beautiful company, but I hope you're learning as much as you can here. Next comes another company called Smartworks Co-working. Now, co-working spaces in India have been doing phenomenally well. I don't know how, but it is working wonderful. The working ecosystem has kicked in. I am currently in a co-working space, but the whole office is mine, but we're still in a co-working space, and they are doing really well. And now if I think about it, would I go do furnishing of my own office, figure out my own Wi-Fi, figure out my own housekeeping? I would not do that. And Smartworks has now become the largest office campus operator, one of the largest in India, right? Now, if you look at them, what have they said? They have a total built up square area of 16 million. The more area they have, the more revenue they can make. Operational out of that is 10, leased is 13, and mature centers are 8.9 with around 202k seats, which is 2 lakh seats. And they basically go by seat cost. Like I, for example, have a 30-seater managed office that I currently have, and every area has a different seat cost, right? They have guided for a 28 to 30% revenue growth over a period of time, and they're saying EBITDA margin will be at 20%. Now, please note, these guys are not very PAT accredited, mainly because they make good EBITDA, but they have to buy the center, or they have to lease the center, they have to do a joint venture for the center, they have to pay a lot of money up front, design the entire office. For me, this entire thing was designed by them. I didn't pay any money. I just had to give a deposit, and that is how they work. But over time, once they have done this, the revenue keeps growing. The revenue inflation keeps growing at 5 to 7% every year, and they try to blend the cost coming soon into it, right? And over a period of time, this cash flows will become insanely beautiful, and there is lock-ins as well, right? So I have a 2-year lock-in in this office, but in 1 year I have maxed out the entire office. So that is how it is. So they're saying that 80 to 85% through near 3 quarters, they will have good occupancy, because in this business, if you have space and you don't have people occupying it, it's a big problem. So you need to have as much occupancy as possible in the space. So Smartworks is guiding for 28 to 30%, 19 to 20% EBITDA margin, and 5,400 crores is contracted, with 87% already contracted, and in 2027 that is going to come as well, right? So if I show you the difference of if I do the fundamental analysis of this company, you can see that it's still a small company at 5,000 crores. A lot of futuristic possibilities are baked in, but again, in this company you don't look at P ratio, because they have to put a lot of capex to grow. So this I can look at more from an EV EBITDA standpoint, which is 7.63 over here, and I can even look at some market cap to sales kind of a ratio, right? Because I would peg these guys on EBITDA more than pegging them on P ratios. The P ratio will come suddenly one day when the growth kicks in. So this company has not gone up, but they're guiding for very aggressive future growth. Now I know all of you guys will tell me, Shashank, why are you showing me companies only that's up? So now I'm showing you companies that are also down, but they're in the growth curve coming very soon. But I know none of you will take such bets. You want something that is high only. So if you look at the growth of this company, it is beautiful. As I told you, the P ratio will be muted mainly because of depreciation and interest cost. But if you look at the operating margins that these guys are playing, it is 63%. That means if the debt goes and if the depreciation gets normalized, this will be a cash rich business. But they use the cash to buy more and more centers and buy more and more leasing spaces, mainly because this is a very competitive industry, and this industry is also moving from unorganized to organized. And as you can see here, a lot of people get scared with the borrowings of 4,700, but this is not long-term borrowings. Long-term borrowings are only 135. These are all lease liabilities. Lease liabilities is because they come into a partnership with someone and they lease the property from the owner rather than buying the property upfront, right? You have fixed assets where they're also buying some amount of it at 3,200 of building space. And if we look down here, if we look at the promoter holding, it has been absolutely the same and everything remains wonderful here, right? So this is again going to come into a growth trend, and they have something called flexi office space. Like they have something called flex that is again doing very well as well. So these are some very interesting companies that I'm showing you, but these are all the ones that I've guided very well. Now comes a very controversial company called Tata Technologies, which many people don't like because Tata Technologies and KPIT have fallen like there's no tomorrow. Now I want to address this for people who keep asking me about KPIT. KPIT has fallen quite aggressively. It has fallen almost 70% from the top. Let me just show you, right? Last 1 year is only 50%. It has actually fallen 70% from the top, and TCS has fallen 50% from the top. So if a large cap is falling 50% in the IT space, a mid cap will definitely fall 70%, right? Do I say that this is a bad company? I still don't think it's a bad company. It is a good company. It is going through a bad phase, and it's not just this company going through a bad phase. The entire IT sector is going through a bad phase, right? But that is where gems are made, when you have the conviction. But for conviction, you should have research, which I have, you don't have, right? That is why you feel that, oh shit, what should I do? Should I sell? Should I buy? And if you have only 10% of your holding in any company, you should never bother about anything. But let's understand a little bit more about technologies. Tata Technologies, Tata company. If you look at them, majority of their businesses in services and 23 is in technology solutions. Their services mainly comes from engineering and R&D, similar to KPIT. KPIT works with more auto companies, whereas this company works with different kind of companies as well. They work with Siemens Industry, Dassault Systems, aerospace. So they work with a lot of aerospace companies. They also work with some McLaren, Honda and auto companies as well. Now they have said that the next few quarters, next year, we will get double-digit organic revenue growth. Without acquisition, they will get organic growth, and we actually see revenue accelerating. Now this is a very interesting point for me because I want to see if they actually do this. That means the whole sector might do a turnaround again, and I want to see the management commentary of all sectors to understand what is good and what is bad. Now it might be that only Tata does a review turnaround and maybe other companies don't do because they have a lot of money coming from the aerospace. And if you see, they're saying 40% CAGR of aerospace is coming. 10 million they got only in this quarter, and they're going towards 100 million. So aerospace is a booming market, and that is something that they're focusing on a lot, right? So this is something that they're going. And if you look at Europe and Germany, where most of the problem is coming up right now, even for KPIT, they're saying Europe and Germany are inflecting with a caveat the CFO flagged the temporary headwinds as some German customers pursue restructuring and cost optimizations, because many people in Germany today are suffering mainly because of the rise of BYD, and then they had to put export controls. So a lot of things are happening, right? Whereas Tata Technology pivoted to aerospace, and that is where they are making good money from. If I show you the fundamentals of this company, it is sitting at 49p. Imagine it's still not fallen down from that peak. It is still at 49p. In fact, now it has done a turnaround from, it has still fallen down from where it was. But right now I can see a change in structure happening from the fundamental standpoint. So as I told you, we need to see on a quarter-on-quarter basis, are they moving towards a double-digit growth from a single-digit growth? If this is going to happen, and if aerospace is going to be the key revenue driver for this company, then this is going to start doing a comeback. I'm showing you companies not just on the good side, like at the peak, but I'm showing you companies even at the bad side, right? Whereas KPIT has not given any aggressive guidance yet, and they're still guiding for single-digit growth rate, which is happening here. So that is why KPIT is not going up, but its peer, Tata Tech, is basically trying to do a turnaround. Okay. Next comes a company called GNG Electronics. Please listen to this very carefully. Wonderful plays happening here with three types of companies. GNG is India's largest refurbisher of laptops and desktops. Then we have Reddington, who basically is the largest distributor of Apple products and some laptop products. Then we have another company called Rashi Peripherals, which is in our basket as well, which is a distributor of laptops. Now, what is happening in such companies, because the whole market is going through a memory upcycle, memory shortage, right? Samsung, Micron, are doing very well. Because there is a memory shortage, all of these companies have increased their prices, and that is why the revenue starts looking very aggressive, right? Because they make money only on volume. So Rashi, same thing happened. Rashi, what they did was they went and bought a lot of inventory in the past, and now the prices of the same inventory that they bought for 100 rupees became 120, so they sold it for 130, and they made huge profits and huge margins. Reddington basically distributes Apple products, and Apple increased their prices because of memory, and now Reddington, which has the old mal, is now selling it at a higher rate. So a lot of these margin accretive stuff is happening. Same with GNG Electronics. They also sell refurbished laptops and all to all these offices. And if you look at this, international revenue is basically 60%, Indian revenue is 40%, and major growth is basically coming from the memory upcycle. They're guiding for 30% growth, right? Earlier they said 25, now they're saying 30, and they're saying that we will come to a 1% net profit margin, and they currently export to 49 different companies, right? And they are saying that right now the management is shifting from commoditized resale towards brand, warranty, everything is going to come into this. Earlier they were just selling it, reselling it, refurbishing it. Now they are doing that. Then they said the industry view runs on two tracks. One is the shortage of memory, and the second is new PC inflation. And this all of us know who have PCs at home. Buying a Apple MacBook has become very expensive right now. Any PCs become expensive. The core bet is that prices will normalize eventually, but till then everyone's making a lot of money in this ecosystem, right? You look at Rashi Peripherals, it's on an absolute tear. You look at Reddington, it is on an absolute tear, right? Reddington recently went up a lot. So this is how it is. And let me show you GNG again. GNG is at 42p here, 3 price to sales and 0.71 peg, and this has not even started the journey yet, right? So these companies are actually doing very well. So I thought I'll just show you that also. Then comes one more very interesting company called Senores Pharma, right? I think this is the last company, but this is a very interesting company, and I want you to hear this very carefully. So Senores Pharma is a company that exports a lot of products to US and UK. Okay, so North America and US is where they export a lot, and they basically export products which are good for drug abuse. So in US a lot of drug abuse happens. So to calm those people down who are addicted to drugs, they basically sell a lot of stuff there, and they are in regulated markets. Okay, and US, for example, they have to be working very closely with the drug administration there, and they have to have products that are approved by them. So it is a very difficult thing to get approved, but once you get approved, you get a lot of revenue from them, right? So these are all the customers they have in India and US, and they work a lot of stuff with the US government there as well. Now they are saying that they are projecting 30 to 40% growth guidance, and I'll show you Senores. They've been growing much faster than this in the past. PAT, they're saying 50 to 60% growth. Beyond 27, we will still grow at the same rate. They have approved almost 35 ANDAs launches are coming, right? Drug discoveries, and 39 modules are in pipeline, molecules. Now doesn't mean all molecules will do well, but if even one molecule does well, then the company will basically explode and do extremely well, right? So management expects a very good growth trajectory, and approved and ANDAs almost doubled from 12 months. And the better that ANDAs, the more revenue each molecule will actually get. Now if you look at 4 routes, each take ANDA to a point sale. So now they are going through different stuff, 4 distinct routes. Okay, the Zoraya platform sells front end and Senores owns the label. Then they have Amerizin, which focuses on government business, which I told you is a very big business for them. B2B licensing they're also doing, and then they have their own CDMO and CMO verticals as well, right? So if you look at this company right now, Senores, it is at 48p, price to sales is at 9, and PEG ratio is at 0.35. Absolute mad journey it's going on. And if you look at the quarterly sales, it's very unique. It is growing very aggressively, and we keep thinking that it will not grow, but it keeps growing at the same speed. So Senores Pharma is a very unique company and does revenue from 2 to 3 different places. Now if you look at all these companies, 9 out of 10 put a average percentage which is very good for FY27 growth, and I've put this, so everything is about 25% and above, and this is something that everyone should read and understand. So these are all the 10 companies in one place along with the table, and this is something that I have done for you guys. Apart from that, I have also made a very nice document for you guys to read whenever you're free, which has all the information. So whenever you're free, you can go through it later as well. I will put the link for this along with the small case link and the discount code as well. But again, I know this was a slightly longer video, so apologize for that. But if you got any value in today's video, and I know if you have not subscribed to this channel, I strongly suggest you do, and I request you to do it because you would really love this video going forward, right? We are coming up with more videos. The next video will be about top 5 dividend yield companies, and I will go deep into those companies, analyze the dividend ratios and all of that. So I hope you guys enjoyed this. It was slightly longer. If you did, please let me know in the comment section, did you like this? And if you did, tell me what else would you like me to cover. This is me, Shashank Godappa, signing off in front of you guys. Thank you guys. Take care. Bye bye.